Okay, so hi everyone, welcome back. This is going to be the first lecture, and first of all, we are going to start with the paper pattern. Okay, so focus on this thing, that this is how the question paper will come in your exam. This is the ultimate result, ultimate objective, where you will be solving this paper brilliantly to score maximum marks in SFM. Okay, so before starting over to the syllabus and the content, we should first set up our mind according to the question paper. So it is very important for us to understand the pattern of the paper. Now this is May 2022 paper, the latest paper that I have right now, and I have downloaded it from the institute's website. I will just show you, if you want to download the latest paper, where you can go and download it. Once you go to the institute's website, you will see over here there is a section for students, and in students there is another section called as Board of Studies Knowledge Portal. In that you will have to go to the final course and then select the strategic financial management, and here on the fifth point, question paper tab is there, and the latest paper can be downloaded from here, May 2022. Okay, so I will just come over to this paper. Now let's have a look on the question paper. It is very important, this video is very important for those students who have not yet appeared for CA final SFM paper and not even have got a chance to look at the question paper pattern. Okay, so this is very important for you to understand the pattern. Now let's start from the very beginning. You will have to write down roll number here. There will be total number of 6 questions here. Okay, and you are allowed to solve it in 3 hours maximum time. Total number of printed pages 12, maximum marks 100. The number of printed pages may change according to your attempt. It may be 13, 14 or 10 or 11, like that. So the next important thing is here. Answer to questions are to be given only in English. First of all, and this is applicable to all of you, except in the case of candidates who have opted for Hindi medium, those who want to write the answers in Hindi. Some people may not be that educated in English, and they may not be that fluent in English, good at English, that they have opted for Hindi medium. Okay, so I think hardly 1 or 2% maybe will be the total number of students for Hindi medium. So they will have to write down Hindi answers. But those who have opted for Hindi medium, or say those who have opted for English medium and writing Hindi answers, the marks will not be counted at that time. The answers will not be considered at that time, and that is what is written here. If a candidate has not opted for Hindi medium, his or her answers in Hindi will not be valued. Now, the most important part, question number 1 is compulsory, sir. There are total 6 questions, out of which the first question is first question is compulsory, and what you have to do from rest of the 5 questions, not fifth, rest of the 5 question you have to solve any 4. You have an option. Candidates are also required to answer any 4 questions from the remaining 5. That's cool. There are 6 questions. First, second, third, fourth, fifth, sixth. First is very, very important and compulsory. And rest of the questions, in rest of the questions, you can skip only 1. Working notes should form part of the respective answers. Please understand that whatever working you do, not the rough working, the working to calculate the main answer. So working you are doing, it fetches marks. So it will fetch some marks to you. So make sure it is a part of your answer itself. Now come back to, let's move ahead to the paper pattern now. Now how the questions are been asked. This is question number 1, sub question A, and we can clearly see that this is a practical question. Okay, not a theory one. Practical question asked for 8 marks. So what we are going to do, we are going to mark it as P for practical. Then question number 1B, here it is B, again for 8 marks and again practical. Now you can see this is question number 1C, just a one liner asked for 4 marks, and this is theory. So to summarize, we can write down here that it was question number 1, A, B and C. It was practical and then theory. It was asked for 8 marks, 8 marks and 4 marks. In total it was 20 marks question, and it is compulsory. You don't have any option to skip that. All the question in this, all the sub questions in this question has to be solved. Now come over to the next question, question number 2A. You can clearly see this is also practical question for 8 marks. All the details are given here. Okay. Then 2B, practical questions again for 8 marks. And here you will see 2C, one liner for 4 marks, theory question. So question number 2, again A, B, C, practical theory, 8, 8, 4, total 20 marks. Now question number 3A, you can say it is a practical question for 8 marks. 3B, practical question for 8 marks. 3C, one liner for a theory question for 4 marks, same pattern. 4A, practical question for 8 marks. 4B, practical questions for 8 marks. Again 4C, one liner for theory of 4 marks. Then 5A, practical. 5B, practical, 8 marks. C, theory, 4 marks. 6A and B both are practical, and 6C have been again asked for 4 marks, and that too theory. The good part in 6C is there are 2 theory questions and you have to choose any one. So if it is difficult for you to solve this, you don't have any idea about what is angel investors and all that thing, and there is a mistake in the institute's paper. It should not be angle investor, it should be angel investor. So there was just a spelling mistake. So angel investor, if you do not know the answer of this question, you can solve this one also. So you have to choose one of the two, whichever suits you. You can opt for that and you can fetch that 4 marks. All in all, what I want to say is the pattern is like this. Question number 3, A, B, C, practical theory, 8, 8, 4, 20 marks. Question number 4, A, B, C, practical theory, 8, 8, 4, 20 marks. Question number 5, A, B, C, practical theory, 8, 8, 4, 20 marks. And question number 6, A, B, C or C. Okay, there are 2 C sub questions, practical theory or theory, 8, 8, 4 or 4, total again 20 marks. So this is the paper pattern. And you can clearly understand that there are 6 questions, out of which the first question is compulsory, and out of the rest of the 5 questions you will have to solve any 4. But pattern in every question is same. The first 2 questions are practical, the last question is theory. First 2 questions are practical, the last question is theory. Practical question have been asked for 8, 8 marks, and the theory question have been asked for 4 marks. Pretty simple pattern. Okay, but this is not going to be the thumb rule in every paper. What might happen in your paper can be slightly different from this pattern, and how it will go, like I will tell you. It may happen that any of the question can be asked in such a manner. Let's take for example question number 2A have been asked for 12 marks, B have been asked for 4 marks, and C again for 4 marks. So it again goes to 20 marks. If there is one big question for which 8 marks is insufficient, is not fair, it will be awarded a little higher marks, let's say 10 or 12, and then second question will be asked for 4 marks only. Okay, it may also happen that the first question is 10 marks, then the second question is 6, and then the third one is of 4 marks, again contributing to 20. It might also happen that let's say question number 1 is there and they will ask you 5, 5, 5, 5, A, B, C, D. That's 20 marks. They can skip the theory in the first question also. They can ask you like this. I have also seen question papers in which the first question was like this: 5, 5, 5, 5, 5, A, B, C, D, E. And they told that you have to solve any 4 out of 5. You have to solve question number 1. But in that one, there are 5 sub question and you can choose any 4. So that might also happen. This is again good for you. So marking system may change, but in totality you can say that 90% of the time this pattern will be followed. There will be 6 questions. Every question will have 3 sub questions. The first 2 sub questions will be of practical and the last one will be of theory. So practical constitutes 16 marks in every question and theory constitutes 4 marks. You have to only solve 5 questions, right? So if we go by that rule, 100 marks are divided into practical and theory. So practical question 8 marks each, 2 question sub question in each question, that goes to 16 marks, and in such a way there are total 5 questions. So total 80 marks. If you go for theory, every question has a sub question of 4 marks and there are total 5 questions that you have to solve, that goes to 20. So this is the rule for practical and theory. 80 marks will be of practical and 20 marks will be of theory. Okay, that's good. Now, what is most important to understand here is that you do not have any option to skip the theory part. If you don't like the theory and you want to skip the theory, this is not possible. We are extremely sorry for that. Institute has said that. Earlier in the previous exams, institute have like used to ask the theory question at the end, giving an option to the student that you can skip the theory part and you can just solve all the practical part. But most of the student used to skip the theory part, and that was like, it was defeating the purpose of institute, that people are not reading theory. Now in this pattern, theory is not an option. You have to solve the theory questions. You do not have any option like that. So theory is also important at the same time. I have told you, I have just given you like around 15 minutes on this to make you understand that the theory is very important. The practical and theory combination pattern will be there in exam. So how to prepare now is going to be the task. Okay. So this was all about the paper pattern. Now let's discuss couple of things about the weightage that has been given by the institute to every chapter. Now this is weightage sheet that has been received by you along with the fast track batch. In this there are some markings that you will have to do. Okay, what I am going to do is I will give you some idea of which chapters are will be there for theory and which chapters will be there for practical questions. Okay, so do some marking here. The first chapter is financial policy and corporate strategy. It is purely theory chapter. 4 marks of theory will surely be asked from this, is going to be asked from this chapter. Risk management is theory and practical chapter both. So they can ask 4 marks of theory or 8 marks of practical question from this chapter. And this both of these chapters are very small chapters. Security analysis is again theory and practical chapter. They can ask 4 marks of theory and 8 marks of practical question on this. But the good part is on this practical question side, there are only 2 concepts, EMA and run test. Mostly you will find the questions on these topics only. Okay. Nothing much on the practical side in that chapter is there. Now comes the main practical part. The security valuation, purely practical. Portfolio, practical. Securitization is theory. Okay. Now, let me pause and give you a clarity on this, that security valuation, I have written it as a practical chapter. Portfolio, I have written it as a practical chapter. Although some chapters I am going to write only as practical, but please understand that institute can ask any theory question from any chapter, even though they can ask theory question from portfolio chapter. So there is no thumb rule. Whatever I am writing here as T or P is based on 90% of the probability. Okay, not 100. Because it is not a thumb rule given by the institute. That is what my analysis of the past exam paper is. Securitization is a small chapter, theory chapter purely. 4 marks of question will be asked every time in every attempt from this chapter. Mutual fund is again you can say practical chapter. 8 marks of question will be asked from this. Derivatives big chapter. Practical chapter. Forex again practical. International financial management again practical, although theory can also be asked from this. Interest rate risk management again practical. In May 2022, theory questions were asked from these two chapters. Most of the time the practical questions are asked from these two chapters, but in May 2022 theory questions were asked from these. So you do not have any option to skip any chapter for theory. Okay, then corporate evaluation, practical. Mergers, practical and theory both. Startup finance, theory only. 4 marks easily can be scored from the startup finance chapter. So in totality there are 14 chapters. Major theory chapters are first, third, then 6th and 14. 4 major theory chapters are there. Out of that, the first one, 6th one and 14th one. Mark these 3 chapters every time in every paper. Theory, in total how many theory questions are there? I will just tell you. 6 theory questions are there, out of which 5 you will have to solve. So out of 6 theory question, 3 theory question will be asked from these chapter. Chapter number 1, financial policy and corporate strategies. Chapter number 6 and chapter number 14, securitization and startup finance. So please make sure this is not going to take much of your time to go through this chapter and have a strong grip on these chapters. But in less number of hours you can score maximum marks. 4 4 4 for sure. So 12 marks is for sure. Like you can guarantee your 12 marks. You can confirm your 12 marks in minimum time. So make sure that you have a strong grip on these chapters. Now comes the weightage part, the past exam paper analysis. This is what institute suggests, that we are going to ask around 20 to 30% of the entire question paper from 3rd, 4th and 5th chapter. Institute says that, but it doesn't happen in reality. This weightage is just for the idea that you can keep in your mind, but in reality there can be 24, 20 or 30% of the marks from security valuation itself. They can ask for 30% of the question from forex chapter itself. Anything. Okay, just give me a minute. Okay, so now we will come to the first volume, 4th edition. So this is 4th edition, volume number 1, and in that you will have to come over to this chapter wise mark distribution. Chapter wise marks distribution from past exam paper. So you will get a good idea, and here I'm going to give you a secret tip to score maximum marks in less number of hours, like to prepare for the maximum marks in less number of hours. Okay, so first mark financial policy and corporate strategy as one of the important chapters, or instead of important chapters we will say that this is the chapter on which we should hold a good or strong grip. 4 marks of question almost will be asked every time in this from this chapter. Okay, then comes the risk management chapter. This is also small chapter to cover. It will not take much of the hours to cover risk management chapter. You should also hold a good grip on that. Minimum 4, maximum 8 marks of questions will be asked from risk management. I will just take 4 marks. Then comes the security analysis. You can clearly see that 8 marks of questions have been asked sometimes, and sometimes it is 4 marks of questions. So whenever you see 4 marks in security analysis, it is purely of theory question, and whenever you see 8 marks, it is practical question that they had asked. Okay, good enough. Now goes with the security valuation. It is going to take a lot of time to complete the security valuation chapter, but also it carries a lot of weightage, like 8 marks, 24, 4, 23, and so on. It covers practical question mostly. Then comes the portfolio management. It also covers a lot of weightage, and 16, 20, 16, 10. In such a manner, the questions have been asked for in the previous attempts. Okay, so this what is this basically? 16 marks of the question on portfolio management were asked in May 2022 attempt. It is like that. Okay, then comes the securitization. Again, the small chapter. You should hold a good and strong grip on this. 4 marks of question is guaranteed from this chapter. You can clearly see the past analysis: 4, 4, 4, 8, 4, 8, 4, 4, 4, 5. When you know that in like around 10 pages I can cover up 4 marks, before doing any other chapter you should be revising this chapter 10 times. Good. Again, mutual fund. You should hold strong grip on mutual fund. 8 marks of question is guaranteed from this chapter minimum. And if they ask for more, then it is cherry on the cake. Now you can clearly see that mutual fund chapter has a good, not the best we can say, but has quite good weightage in exam. There have been 16 marks of the question in the previous attempt: 8, 12, 8, 14, 10, 8, 8, 10. So minimum 8 marks. It carries a weightage of 8 marks, and it is a small chapter, easy chapter. You can easily understand this chapter as well, so you will easily be able to score 8 marks in this. Derivatives is going to be one of the difficult chapter to you. Derivatives and interest rate risk management, because the concepts in these chapters are little like are not related to practical life of like till the student time. These are the practical world already going on in the market. Like derivatives are being traded, are being used in the market by lots of people in real life. But the main thing is the time at which you are studying these chapters. Till that time, till that age, you may not have gone through these concepts, and that's why you may not be able to relate it to the real life. So this is going to go a little on a difficult side to you, unless you are from a background where your father or mother have been into trading, or a broker, stock broker, or you have been trading for call, put, futures and options like this. Unless that. Okay, so derivatives practical, interest rate risk management practical, foreign exchange, one of the most important chapter of your syllabus. Like I have it carries the first rank in terms of marks, minimum marks or average marks in each attempt. Then comes the international financial management, corporate valuation, again practical chapter. This also is a good chapter to hold a strong grip on, and you will easily get 8 marks in this. Then the last chapter is the startup finance. You will have to hold a good grip in this, and you will get 4 marks for sure. So whatever the marking that I have done here, there are total 6 chapter out of 14. And I will tell you one thing: the time it is going to take you to complete forex chapter. Let's take the biggest chapter, forex chapter. Let's take, you are going to take around 10 hours to complete forex chapter, and forex chapter on an average carries 14 marks. Okay, on an average carries 14 marks. You will take the similar amount of time, only 10 hours, to complete these 6 chapters that I have noted here: financial policy, risk management, securitization, mutual fund, corporate valuation, and startup finance. And in total, you will score 4 plus 4, 8, and 4, 12, and 8, 20, 28, and 32. Let's say out of 32, I can skip 4 marks. I'm just removing 4 marks because there will be some optional question where you will be leaving one of these chapters. So at least 26 to 28 marks of the question can be covered in the similar, or can be prepared in that 10-hour time frame, which is the same time you will take to complete forex, and still will be able to not fetch more than 14 marks. So that is why I'm telling you that these are the chapters which on which you should hold a strong grip, because first, these are small chapters, will be covered fast and will be completed in less number of hours, and you can easily understand the concept, and also there will be good marks that you will secure for your exam. This is how you should prepare for at least getting an exemption. If you want to go cross 50-60 now, you should prepare with a proper analysis. It's not like our first chapter, then second chapter, every chapter you are giving the same time and same importance. It's not like that. You should not do that. You should be smart enough to understand that how I should go ahead. So this is how the paper pattern is. Obviously we are going to cover up every chapter, but these are the 6 chapter where you should hold a strong grip. You should have a strong grip that if any question has been asked from this chapter, you will be able to easily solve it. So mark my words, if you do this, you will be easily able to score exemption in your SFM paper. Okay, from the next lecture I'm going to start with time value of money. That's the basics, and it is covered in the foundation in your syllabus, but that is something on which the rest of the chapters are dependent. So if you don't understand the basics, you will not be able to understand the rest of the concepts and will not be able to solve the questions. So I will take a break of 5 minutes and I will be back with the basics of time value of money. See you. So welcome back after the break, and now we are going to cover up the basics of your syllabus. The basics that we are going to learn in this next 1 hour is going to be helpful for you in the chapter security valuation, that will help you in the portfolio management, that will help you in the corporate valuation, that will help you in mergers and acquisition as well. These are the 4 important chapter. After that, it will also help in the derivatives chapter. So you can understand that the names that I have taken are the most important chapters in terms of marks of your syllabus. If you miss out on these basics, then you will find it difficult to understand the formulas and the concepts in those chapters later on. So don't underestimate the value of these basics that we are going to learn. Okay, so the topic name is time value of money. This topic of time value of money, if you remember, it was covered in CA foundation level. I don't know whether you have put much of the importance to these topics, these concepts or not at the CA foundation level, but it is my responsibility to cover up and understand, make you understand all these concepts. What you can do right now is, if you are thorough with these concepts, you can just skip this topic and just go to the next lecture. But I would request you to pick some time out of your busiest schedule, as I can understand you're preparing for the final exams, and spend 1 hour learning more than what you have learned in past about these concepts. So our time value of money concept covers around 6 basic topics: simple interest, compound interest, effective rate of interest, present value, future value, and present value of annuity, and perpetuity. Just give me a second. Okay, so there was some lighting issue. Now these 6 points will be covered by us. Before starting the simple interest topic, let me make it very clear that there is some time value to the money. Why the name is given? So let's take an example that if I ask you to lend me 100 rupees today, and I promise you that I will give it back to you after 1 year, the same amount, 100 rupees. So the story for you is like, you will give 100 rupees today and you will get back 100 rupees after a year. Will you be okay with this transaction? You will not be. You will not be okay with this transaction, as you will say that what is the benefit to me on this transaction? I'm giving you 100 rupees and I'm getting back 100 rupees itself. There is no extra money involved in that. My question is, why do you want extra money? Why do you want extra money? You are getting your principal amount back to you. So you will then understand that you are losing on money if you entertain this transaction, if you agree to this transaction, if you accept to this transaction. And why you will lose money, I will tell you. The value of 100 rupees which you had lent me 1 year back has decreased. You cannot buy the same amount or same quantity of products today which you were able to buy it 1 year back. Let's take an example. Just a second. So have a look. What is this? So this is 100 rupee note, okay? Now today if you lend me that 100 rupees, you are losing on the opportunity to buy something out of this 100 rupees. First of all, because you will not have this 100 rupees with you. Second, you are losing out on opportunity to invest this 100 rupees somewhere where you can earn more money on that after a year. Let's take an example that if you put this 100 rupees in stock market or mutual funds or fixed deposit or any bank, what will happen after 1 year? That the bank will give you this principal amount along with the interest. Let's take an example that the interest is 10%, interest rate is 10%. So how much will be received by you after 1 year? After 1 year, the bank will give you 110 rupees. Am I right? If the bank is going to give you more money after 1 year, why you will just accept the same amount of money from me after 1 year? So you will not be ready with this transaction because your money, please understand, your money has value over a period of time. Second angle of looking at this transaction is, due to inflation you cannot buy the same quantity of products today. After 1 year you cannot buy the same quantity of product as you were able to buy it 1 year back. So let's take an example that if you were able to buy this calculator at 100 rupees at time 0, will you be able to buy the same calculator at 100 rupees after 1 year? No. And the reason is inflation. The inflation causes the price of this product to increase. The price of the product will get increased after a year, and it may cost you around 120, 110 or something like this to purchase the same product. So the value of the same rupee note, this 100 rupee note, will get decreased over a period of time, and that's why you will need more money from me to cover up that decreased value. So you will say that at least give me 110 rupees so that you were able to purchase a calculator at time 0 at 100 rupees and at time 1 at 110 rupees. That's fair for you, okay? That is why we say that the time has value. The money has a time value. Now comes the first concept, that is simple interest. Let's get back to our iPad. I hope it is clear to you. Nice. So the very first concept is simple interest. Now what is this? If you invest 100 rupees at time 0 at a rate of 10% per annum, the amount that you will receive after 1 year comes to 10 rupees. Very easy. Okay. And what is the formula for that? 100 rupees that we have given or invested at time 0 will be called as principal amount P. The 10% rate that we are getting on 100 rupees will be called as rate of interest, and the period for which we kept that 100 rupees invested will be called as T, time. So to calculate the amount of income that we have earned, which is called as simple interest, the formula will be principal into rate into time. Principal into rate of interest into time. So if this rate of interest is per annum, the time should also be per annum. If this rate of interest is half yearly, the time should also be half yearly. So if I'm saying that I'm going to earn 10% per annum and I have invested only for 6 months, at that time I cannot write 6 here, because 6 will be months and 10 will be year, per year. Okay, what I have to write, instead of 6 months I will have to write 0.5 year. It should be in annum, it should be in years. Okay, if the rate of interest is in year, it should be, time should also be in year. So all in all, what you need to understand here is the rate of interest and the time, the base of both should be same. Either both should be in months, either both should be in years. Are you clear with this? Okay, now let's take another example in simple interest. If you invest 100 rupees today, and that too for 5 years, not just 1 year, 5 years, what will happen? You are earning 10% per annum. So every year you will be getting 10 rupees. So 10 rupees, 10 rupees, 10 rupees, 10 rupees and 10 rupees. In total you have earned 50 rupees. How to calculate that 50 rupees in now with the help of formula? It will be the same formula, that is principal plus rate of interest into time. So 100 rupees into 10% will give you 10 rupees, into 5, that is 5 years, will give you 50. Are you clear with this basic concept? I think nobody will have issue with this. So we have started the SFM study with the very basic understanding of simple interest. Okay. But till now what we were assuming is that once we have invested 100 rupees, we were receiving 10 rupees every year. So all the 10 rupees that I have written here was the cash flow to you, cash inflow to you. It was the cash inflow to you. So you were receiving it in your bank. Now what I want to say is that what if the bank does not give you that 10 rupees after 1 year? You have earned 10 rupees, but it is not given to you, it is accrued. It is being kept by the bank itself and used by the bank itself on the second year as well. If you will see the graph, you have given 100 rupees to them, you have earned 10 rupees, but it was not given to you, although you are eligible to receive it. So what is happening? At this point of time, the bank has 110 rupees of yours with them. Now on the second year, the bank is using 110 rupees of yours. So practically speaking, if they are not giving us 10 rupees to us, then they should, please mark my words now, they should pay interest on the second year, interest for the second year on principal as well as the interest that they have kept from my earnings. So they should pay interest on 110 rupees and not just 100 rupees. Interest is to be paid on the amount of money used by the bank of the investors. On the second year, the amount of money which was used by the bank was not just 100 rupees, it was 110 rupees. So the bank should pay interest on interest, interest on interest, and that concept is called as compounding. In this case, we were assuming that this 10 rupees was received by us every year. But now what we are assuming is that this interest will not be received by us every year. It will be given to us along with the principal only at the end of 5 years. And when this is going to happen, it means that the bank is using our earnings in this interval as well, and they should pay interest on these interest as well. So the 10 rupees earned by us is being used by the bank for the next 4 years. The 10 rupees earned by us here is being used by the bank for the next 3 years, and so on. This concept is called as compounding. What happens in the compounding is you grow your money more than you were growing while using the concept of simple interest. In compounding, you never get paid meanwhile in the intervals, and that's why your money always stay, your earned money also always stays with the bank or wherever you have kept it. So you keep on in income, if you keep on increasing your revenue or income on the interest as well, that is called as compounding. Okay, now what is going to happen in the compound is, the principal amount is 100 rupees, rate of interest is 10% per annum. Compound amount means the amount that you will receive at the end of the period is, compound amount will be principal plus compound interest. 100 rupees of the principal amount, 10 rupees of the compound interest, and it will be 110. For the first year, the cash flow in compound amount concept and simple interest concept will look same. But compound amount and compound interest will give you different cash flows from second year onwards. Now we are going to look at this. Have a look. If the compounding happens annually, means if we are eligible to receive money, if we are eligible to earn money annually, then what will happen? Let's say we will invest for 5 years. We have invested 100 rupees for 5 years and the compounding is annual. In the very first year, what is happening? We have earned 10% on 100, that is 10 rupees, but it is not being paid to us. It is not given to us. So at this point of time, practically speaking, we have 100 rupees and 10 rupees of us with the bank. So bank is going to use 110 rupees the very next year. They have not paid yet the first year of interest, right? Now, in the second year, the bank will give you 10% rate per annum on this amount, the amount that they are using in the next year. So 10% on 110 will give you 11 rupees of the interest. The second year interest is not just 10 rupees, it is 11 rupees. And still it is not being given to us. It has been kept by the bank itself. So 110 plus 11 is the total amount of yours which has been kept with the bank and lying with the bank. It becomes 121 rupees. On the third year, the bank is using 121 rupees of yours. 100 rupees principal, 10 rupees 100 rupees of the principal amount, 10 rupees of the first year interest, 11 rupees of the second year interest, totaling to 121. And in the third year, the bank will pay the interest on 121. That is goes to 12.10. And then on the fourth year, the bank will use 133.10 rupees of yours in total. It includes the principal of first year interest, second year interest, and the third year interest as well. And this keeps on going and going and going, and at the end of fifth year, you are going to receive everything. What is the amount that you will receive at the end of fifth year? Let's calculate. The amount that you will receive on the fifth year is the compound amount, which is equal to principal of 100 and all the compound interest. If you total the compound interest, you will get something like this. 10 rupees of the first year, then 11 rupees of the second year, 12.10 interest for the third year, 13.31 interest for the fourth year, and 14.64 interest for the fifth year, totaling to 61.05. So 61.05. The compound amount at the end of 5 years that you will receive is 161.05. Now, what is the benefit of not receiving the intermediate cash flows? Is that the same interest or the same cash flow is being used by the bank again, and you are earning interest on that as well. So here the magic of compounding will result in an increased wealth, in your increased wealth. See, let's take an example of the simple interest. If you go with the simple interest. At that time, the amount that you will receive or you will have at the end of 5th year is simple: principal plus simple interest. So principal was 100 rupees and the 5-year simple interest was 50 rupees. It was only 150 rupees. So as compared to 150 rupees in simple interest concept, you are earning 161.05. You are having 161.05 at the end of the same period in compound interest concept. So this is the magic of compounding. How much extra that you have earned? 11 rupees 05 paisa in the same duration. If you keep that intermediate income with the or if you keep that intermediate income invested and not receive it or not realize it. This is how the concept is. Now the main part is, sir, how to calculate the compound amount. See, it is very tedious task to add all the interest amounts and then add it with the principal. Also, you will have to calculate interest at every point. So, is there any formula for calculating 161.05 directly? Yes, sir. There is one formula. So, this is that formula. Now, we will understand this formula. Okay. First of all, it is very clear to you that every year we should be paid on the principal. Every year the interest should be paid on the principal. That's why this 1 plus will help you. This one represents that you should get interest on the principal as well. Okay. Now just taking the first year. Okay. What is the formula? What was the formula of simple interest? If we calculate the simple interest and the principal at the same time at the end of first year, it is very simple. It is like that: principal in bracket 1 plus r. So at the end of 1 year, you will get 1 plus 0.10. You will keep the principal intact by keeping 1 here. So it will be 100 plus 10, that is 110. Okay. In terms of simple interest also, you will get the same amount, 110, after 1 year. But my point is, next year we should get 10% on this as well. That will be 110, 121. And the next year we should get 10% on this as well. That will be 133.1. And we will repeat the same process again and again. So you will see what we are doing is, we are multiplying 1.1 again and again 5 times. In 5-year period, we have to do this. So the simple formula to do this is like this. Instead of this, we should go ahead like this: 1 plus r, 1 plus r, 1 plus r, 1 plus r. 5 times we should multiply the principal with 1.1. So try doing it. 1.1, 1.1, 1.1, 1.1 and 1.1. If you do this, you will get the answer. 1, 2, 3, 4, 5. Let's do it in the calculator. 1.1. How to do it? You have to multiply 1.1 5 times with itself. Okay. So while you have kept 1.1 in the calculator, the first time has already happened. Now you will have to press equal to button 4 times. I will just show you once again. What you have to do is 1.1, keep it on the calculator, press multiply sign. Okay, 1 time has already happened. Now you have to press equal to button from the second time onwards. So 2, 3, 4, 5. 1.6105. That is the shortcut. Instead of calculating like 1.1 into 1.1 into 1.1 into 1.1, you can just keep on pressing equals to button and it will give you this figure. So 1.61051. And the answer is 161.05. It is the same answer that we have written over here. Okay. Yeah. It is the same answer that we have written over here. Now, instead of writing 1 plus r so many times, what we can do is, we can just simply do it: p in bracket 1 plus r to the power t. T means the number of times that we are going to multiply it. Year, basically. Now one thing will be added over here. This is the basic, But what if the compounding is happening semi-annually? Till this time the annual compounding was there and you were earning the interest annually. But what if I say that you are going to get your income is going to get accrued every 6 months? So if I have to earn interest for 6 months, what will be the rate of interest? If 10% is per annum rate, I will say 5% will be per 6 months rate. Am I right? Semi-annual rate, half of the per annum. See, how many periods of semi-annual is covered in per annum? 2. So what I am going to do? I will divide 2 by 10. Like 10 by 2, I will do it 10 by 2 so that I will get half yearly rate of 5%. Okay. So 5% will be accrued every time. Now please understand what is going to happen here. This is semi-annual part. Okay. Semi-annual compounding. Make it M. Now what will happen? This is 10% per annum. We will earn 5% per 6 months. Now in the first 6 months you will earn 5 rupees. 5% on 100. After first 6 months, the amount of your money that the bank is using is 105. They have not paid you 5 rupees yet. They are using your 5 rupees as well as the principal amount. So on the next 6 months you will earn 5% on 105. That will be somewhere 5.25. I will just write it down like this. 5.25. So if you total 100, 5 and 5.25, it will go to 110.25. In the next 6 months, you will earn interest on 110.25 and this will keep on continuing till the end of the 5 years. Now you tell me how many times your money is being compounded? 10 times. 2 times in a year. Semi-annual means 2 times in a year, and 5 year means 5 into 2. 10 times in the total investment period. So what you have to do? You have to multiply 1.05 10 times. The way we did it 5 times in the annual compounding, we have to do it 10 times. Now the formula will be like this. At that time, what we have to do is we have to just modify this formula a little. It will be P first of all. It was 10% at that time when the annual compounding was being used. Okay. But we have to use 5% now. So what we have to do? We have to convert the annual rate into 6 months rate. That can be done by dividing it with N. N means the number of compounding in a year. Why in a year? Because this rate of interest is per annum. Rate of interest is per annum. That's why the number of compounding should also be per annum. So R divided by N. Now to the power NT. 5 years, number of compounding. How many number of compoundings in total? 10. In total 2 in a year. So 5 into 2 will be 10. Are you getting it? See. Now have a look what we are going to do. In semi-annual compounding, if we invest 100 rupees, okay, 1 plus rate of interest is 10%. We are going to write it in decimal. Number of compounding in a year is 2. Again, number of compounding in a year is 2. And how many years are there? 5. So it is going to look like this. 0.10 divided by 2 to the power 5 into 2. So if you do this, you will receive more money than you were receiving in annual compounding. See, in annual compounding, you were getting 161.05 in 5 years. In semi-annual compounding, you are getting a little more in the same 5 years, 162.89, because your money is being compounded more times than it was in the previous part. If you do the compounding more often, your money gets increased. Okay. Now, coming over to the next part, if you do the quarterly compounding, the formula will be like this. Have a look. How many quarters are there in a year? 4 quarters are there. So N will be 4. So if you do it, it will look like this. 100 in bracket 1 plus 0.10 divided by 4. 4, this is per annum rate. 4 is the quarterly compounding, and to the power 5 years into 4 compounding. So 1.025 to the power 20, 1.6386. How you are going to do it 20 times? You will have to do it. Just see, it is like that. I will show you. 1.025, right? Multiplied by 1 time has already been done. Now you have to press equals to button 19 times. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 1.6386. See, 1.6386. So if you multiply 100 with 1.6386, you will get this. You can do the monthly compounding also. At that time, the number of compounding, how many months are there in a year? N will be 12. So you have to use it like this. You can do the daily compounding. How many days are there in a year? 365. Now it will be very difficult for you to press equals to button 1824 times. If there is 1825 in the numerator, in the power, you will have to press equals to 1824 times, and it is very impossible. I will show you how to calculate that also later on. Not required right now. Without calculator you can do that. Means with calculator, but with another technique you will have to do that. That's okay. Most of the time what will happen in the exam, that something to the power value, let's say for example 1.010123 is there, and to the power 6 is there, something, any figure with x to the power y will be given to you in the question. The answer to this value will already be given to you in the question. They are not checking you whether you know the calculator tricks or not. So that's not important for us. The important is the concept. Okay. So that was all about the semi-annual compounding. Till now we have covered up 2 concepts. Please understand, I am revising it. Simple interest is equal to principal in bracket, principal into rate of interest into time. Compound interest, or we can say compound amount, is equal to principal in bracket 1 plus rate of interest per annum divided by number of compounding per annum to the power number of compounding per annum into how many times? Years. Okay. Now comes the third part called as effective rate of interest, and that will be easy to explain to me if you have understood the concept of compound interest. Now if you will have a look on the compound interest part, you will see one thing. We have invested for the same period 5 years, invested the same amount 100 rupees and invested at the same rate, which is 10% of per annum. But the compounding was different in every case. When the annual compounding was there, we received 161.05 at the end of 5 years. But when we compounded more often, like semi-annual, we received more money. When we compounded quarterly, which was more than semi-annual, we received more than what we have received here. It was 162.89 here, it is 163.86, then 164.50, 164.87. So you can clearly see that, like, the more you do the compounding, the more you will add on to your wealth. Okay, that's very, very clear. Now, my question to you, effective rate of interest. What is effective rate of interest? Effective rate of interest is a simple rate of interest which shows you effectively how much you are earning. Now, if we go to this semi-annual compounding part, or let's take another example altogether, we'll do it. Let's say you invest 100 rupees, rate of interest is 10% and time is 1 year. So the amount that you will receive at the end of 1 year will be 110 rupees. Am I right? Good. If we do it like this, why you will receive 110? I will just make it more clear. If the compounding is annual, then you will receive 110 rupees.
If you invest 100 rupees, rate of interest is 10%, time is 1 year, and the compounding is semi-annual. The amount that you will receive is 110.25 as seen previously. What was the formula for this? Principal compound amount is equal to principal in bracket 1 plus r by n to the power nt. So 100 in bracket 1 plus 0.10 divided by 2 to the power 2 into 1. It will give you like this, 100 into 1.1025 if you solve it, and it will be 110.25. This is how you have reached to that 102.5. Now I will just remove it. There is no need for that right now. Now let's take an example that you have been given with this figure. Okay, this figure, this figure, this figure, and this figure. What will be the effective rate of interest that you have earned? If I want to calculate annual rate of interest for in this case, what was the annual rate of interest that I have earned? 10% is the per annum rate when the compounding is semi-annual. I want to say that if the compounding would have been annual in this case, how much rate of interest would have required you to earn 110 rupees 25 paisa? Very simple. Again, I am repeating the question. Let's keep principal 100. Okay. Semi-annual compounding rate is 10%, or let's keep it a question mark. Time is 1 year. Semi-annual rate, it's not semi-annual now, it's annual compounding now, and the amount is same. Compound amount is 110.25. Now these two cases are similar because the end result is same. This investment is same, time is same. Okay, what I want to ask you is that what rate of interest is required annually in annual compounding to make 100 rupees in 110.25? And it's very simple to you. This rate of interest is nothing but compound interest divided by principal. What is compound interest? The compound amount that you have earned minus principal divided by principal. Am I wrong in this? 110.25 minus 100 divided by 100. So how much you have earned in a year? 10.25, right? On how much amount? 100 rupees. So the rate of interest goes to 10.25% per annum. What I want to say is that if you do the compounding annually with 10.25% rate, or if you do the compounding semi-annually with 10% per annum rate, it will both give you the same answer of 110.25. Am I right? Let's do it and let's prove it. So principal 100, and in case of 10.25%, 1.1025, it will give you 110.25. And in case of 10% semi-annually, the formula will change to little bit, and it will again result in the same answer of 110.25. Okay, this is not required, we can delete it now. So have you understood this one concept, that saying 10% per annum semi-annually will give you the same result as 10.25% per annum annually? Now this 10.25% per annum is the effective rate of interest that you are earning. This is what you have to calculate. Okay, cool. Now how we are going to calculate? See, if we do not have the principal amount and the compound amount and still we have to calculate this rate of interest without any figure, how we are going to do that? And it's very simple. We have to use the same formula. Compound amount is equal to principal in bracket 1 plus r divided by number of compounding in a year to the power number of compounding in a year into time in a year. See, whenever you write a formula, you should read it in whole form, not just r divided by n, because You need practice to mug up those formulas every time. Okay. Now, can I write this p? Can I shift this p on this side? Yes, we can do that. And you can see that p is being multiplied here. So what we are going to do, compound amount, it will go to the denominator on this side, and it will look like this: rate of interest divided by number of compounding in a year to the power number of compounding in a year, time in years, multiplied by time in years. Now, can I write compound amount? If you have read it here, when we started the concept of compound amount, I showed you that compound amount is nothing but principal plus compound interest. So we are going to replace that. It is nothing but principal plus compound interest, and denominator principal, 1 plus r divided by n to the power n t. Now, I can what I can do, I can write that denominator in this form as well, if we follow the rules of maths. Am I wrong in writing like this? What I have done is I have distributed the denominator to both the numerator part. Okay, p divided by p, compound interest divided by p. Again the same thing, 1 plus r divided by n to the power nt. Now, what will happen? P by p is nothing but 1 plus compound interest by p. Acha, okay. One more thing. You remember this compound interest divided by principal? You can compare it with this compound interest by principal, and this was nothing but effective rate of interest. Compound interest divided by principal. So what we are going to do? We are going to write down. This is what we have to find out. CI divided by P, compound interest divided by P, effective rate of interest, 1 plus r to the power r divided by n to the power nt. Now what you have to do is you have to shift this one on that side. Effective rate of interest is nothing but 1 plus r divided by n, means rate of interest per annum divided by number of compounding per annum, to the power nt. Why I am using nt? I have been teaching since 10 years. So I am used to the formula now. But you should use proper form, -1, and this is your formula. See, now without any amount you can calculate the effective rate of interest that you are earning on any situation. Let's take the semi-annual situation. In case of semi-annual part, it was 1 plus 10% per annum divided by 2 times compounding in a year, semi-annual, okay, into 2 into just 1. Please understand that what we do here is effective rate of interest is always calculated on per annum basis. So it is only for 1 year. Hence the time will always be 1 year. So if you do not keep t in the numerator, in the power after n, then also it's all okay. So somewhere if you refer to different books, you may not find t in the power after n. It's all okay because it is always kept as 1. And at some places you may find t, but that is just 1 only at the end of the day, -1. So if you do it like this, 1.05 to the power 2 minus 1, it is 1.1025 minus 1. It has given you the same result, 10.25. Let's do it for quarterly. It will be like this: 1 plus 0.10 divided by 4 to the power 4 minus 1, 1.025 to the power 4 minus 1. It is 1.1038 minus 1, and it's nothing but 10.38% per annum. So this is your effective rate of interest, 10.25, 10.38%. Now have a look on this. I hope you have understood now. In terms of annual compounding, the effective rate of interest and the normal rate of interest will both be same, 10% per annum. But When you do the semi-annual compounding at 10% per annum, the effective rate that you are earning is 10.25. When you do the quarterly compounding at 10% per annum, the effective rate that you are earning is 10.38. That is what we have seen just yet. Compounding monthly with 10% per annum rate is gives you 10.43% per annum effectively if you put it in this formula. So the formula is 1 plus r divided by n to the power n minus 1. There is no t required. Even if you are putting t, it will be 1 only. So this is how you calculate the effective rate of interest. That gives you how much exactly you are earning on per annum basis, not semi-annual, not quarterly, not monthly. Even if you are using this calculation, the per annum rate will be different for that. So we'll use this concept in around 4-5 questions in total in our syllabus. But the most used concept will be the present value and future value concept. This concept is going to be one of the most used in the entire syllabus. Means a single concept which is being used multiple times. A strategic financial management subject gives more importance to the time value of money now, and it is very easy to calculate present value. See, future value won't be that much important to you in this syllabus, but present value is much more of a more importance. Now, have you seen that first example of simple interest or compound amount? Principal invested of 100 rupees at 10% rate of interest gives you 110. So at time 0, the invested amount was 100, and at time 1, means after 1 year, the amount that we received is 110. In other words, we can simply say that 100 rupees is the present value and its future value is 110 rupees. Future value of 100 is 110 and the present value of 110 is 100 rupees. Simple. It is nothing but present means today, future means tomorrow. So this is the tomorrow's value, which we can call it as future value, and this is today's value, which we can call it as present value. So the concept is same. Now the formula for present value will be derived from the same formula that we have learned just yet. Compound amount is equal to principal in bracket 1 plus r divided by n to the power nt. N, number of compounding in a year, r, rate of interest, n, number of compounding, t, time. So compound amount is the future value. We have kept FV in place of compound amount, and principal that we are investing today, we will call it as present value, and rest of the formula is same. So if you juggle this formula, present value will come on this side, future value will go on that side, or we can say that 1 plus r divided by n to the power nt will go in the denominator of future value. So it will go in the denominator of future value. So if you separate that denominator, we can call it as future value multiplied by 1 divided by 1 plus r divided by n to the power nt. And this entire 1 divided by 1 plus r divided by n to the power nt is called as present value factor. Now, I will just take an example. So 110 was the amount that you are receiving after investing 100 rupees for 1 year. Or we can say, yeah, that's okay, that's absolutely fine. This was future value, this is present value, and 1.10 will be called as future value factor, and it was nothing but 1 plus r. Okay, so I will just write it down here. 1 plus r is nothing but future value factor. So 1 plus r. It was a pretty simple question, no compounding, no number of years and all that. But if you include the compounding and number of years, then we have to change the formula to this 1 plus r divided by n to the power nt. Right? If we shift the present value on that side and future value on that side, so it will look like this: future value divided by, this entire thing will go in the denominator, and if we separate the denominator from the numerator, we can simply write it like this: future value into 1 divided by 1 plus r divided by n to the power nt. This entire thing is nothing but 1.10, which goes to 0.909 for 1 year. If it is for 5 years, it will be different. It will give you different figures. Okay, let's not go deep into this right now. This entire thing is called as present value factor. Now, how to calculate the present value factor? We'll take it. Just focus on this now. I will just ask you to focus on this part first. So if the 100 rupees, let's say 100 rupees is being received at the end of first year, this is our future value. If we want to calculate the present value, the value at time 0 of the future value, what we will have to do is we will have to multiply this future value with its present value factor. The formula is very simple, sir. I will just go back here. Multiply the future value with present value factor. And how to calculate the present value factor? One divided by 1 plus r to the power t. I'm just skipping the n divided by n part right now because I'm just considering the annual compounding only for now. So if there is only annual compounding, then n will not be there in the numerator and in the power as well. So it is like this, 1 divided by 1.1, and if you press equals to on the calculator, it will give you first year present value factor, that is 0.909. That is what you will use for calculating the present value of the first year cash flow. But if you receive the cash flow at the end of second year, you will have to bring it to the present value. Okay, what you will have to do to bring it to the present is you will have to discount those cash flows, calculate the present value by 2 years. You will have to bring that 2 years cash flows to 0 time. So you will have to multiply it with the second year present value factor. And how you are going to calculate the second year present value factor? It's very simple. 1 divided by 1.1 to the power 2. It will be 1 divided by 1.21, 0.826. Again, if you want to calculate the third year's cash flows present value, it will be 1.1 to the power 3, then 4, then 5. But this technique is cumbersome. It is going to take a lot of time. Instead of that, what you can do is 1 divided by 1.1, and now if you press equals to, it will give you first year present value factor. Again press equal to, it will give you second year present value factor. Again press equal to, it will give you third year present value factor. Again press equal to, it will give you third year present value factor. Again press fourth year present value factor, and again press equals to, it will give you fifth year present value factor, and so on. You don't have to again and again write down all these things. See, I will show you here. 1 divided by 1.1. Now press equals to, for the first time you will get 0.909. Again press equals to, you will get 0.826. This is second year. Again 751. I will show you here. You see, 751 for the third year. Now if you press equals to, again 0.683. If you press equals to, again 0.621. See, getting it? So it all can be done on the calculator easily. So this is how we calculate the present value. Now we are going to discuss about the present value of annuity concept, and it's very simple. Just now I showed you how to calculate the present value of 100 rupees at any point of time. If you are calculating the present value of the cash flow which is at the end of first year, you will have to multiply it with the first year factor, present value factor. If the cash flow is at second year, you will have to multiply it with the second year present value factor. If the cash flow is at third year, you will have to do it like that. Okay, so if we receive 100 rupees 5 times and we have to calculate, let's say that we have to calculate the present value of all the 100 rupees, then what we are going to do, we will calculate the present value of all the 100 rupees and then total it. But this is going to be a lengthy process, because we can remove the redundant part, the part which is being repeated again and again, which is nothing but 100 rupees. You can see 100 rupees is being used 5 times continuously.
Can there be any solution in which we will use 100 rupees only once? Yes, sir, it is possible. Instead of multiplying again and again with 100 rupees, what we can do is we can total this. We can sum these present value factors. Do the summation of all these present value factor and multiply it with only 100 rupees. Once only. I will show you how it is being done. Let's take an example that 2 into 5 is 10 and 2 into 4 is 8 and 2 into 3 is 6. So the total is 24. But instead of doing this again and again, as we have seen that 2 is being repeated 3 times, we will just take 2 once only. And we will do the summation of all these things which are different in variable. 5, 4 and 3. So 5 plus 4, 9 plus 3, 12. And do the multiplication only once. So you tell me which process is easier and takes lesser time. This process 2 into 24. How you have reached at 24? You have taken 2 and multiplied with 12, and 12 was being arrived by totaling all the present value factors. In the similar way we are going to do it here as well. Have a look. Value of the perpetuity can be arrived by multiplying the annuity. Annuity means a figure which is being repeated again and again. This is annual cash flow, 100, 100, 100, 100, 100, similar cash flows. It is being repeated again and again, so we have taken it once only, and then we have calculated present value annuity factor. Please understand, what you call these figures as present value factor. Present value factor, right? But when you total all these present value factor, we will call it as present value annuity factor. So what you have to do here is you have to calculate the present value annuity factor of 10% for 5 years, and I will show you how to do that on calculator in just a minute. But the basic concept of calculating the present value of annuity means a figure which is being repeated again and again. If you want to calculate present value of all those figures at the same time, you can do it by using this formula instead of calculating individual present values and then totaling up to the same figure, which takes more time and have no sense. We should not be investing so much of the time in exam in doing like this. So present value of annuity. Similar figure which is being used once only. And now the question is how to calculate that PVAF. It's very simple. PVAF is nothing but the total of all the present value factors of 5 years. So what you have to do is on the calculator you reach out to 0.909 and then add it to the memory of the calculator. Then you reach out to 0.826, add it to the memory. Then you reach out to 0.751, add it to the memory, and keep doing it till the time you reach out to the last figure and add it to the memory, and then recall the memory of all the additions that you have made. It is very easy to say it, but now we are going to look at this. So what you have to do is just press 1 divided by 1.1 on the calculator, which is the rate of interest, and then press equals to for the first year factor, add it to the memory, press M plus, then equals to second year factor, add it to the memory. Keep on doing it for 5 times and then press memory recall. I'm going to show it to you now. Have a look. Make sure that memory is clear. So means before starting there should not be M or something out here. Now 1 divided by 1.1. Okay. Press equals to, that is 0.909. This is the first year factor. I will show it to you here. That is 0.909, and then add it to the memory. This is the memory plus button here. What we have done is we have added it to the memory. The moment you pressed M plus only once, okay, you will see this M character here. That means the memory is being added. Now press equals to again the second time, add it to the memory, M plus, third time M plus, fourth time M plus, fifth time M plus. Okay, that's enough. We have reached to the last level, and then you want to ask the calculator to recall all the additions that we have done. For that we are going to press this button MRC.
that is memory recall, and it will give you 3.7907. That means 3.791 if we round off to 3 digits, it's 3.791. That's it, simple, easy. Okay, so this is where we are done with the present value of annuity concept. We are going to use it like at multiple places. So if you are at least 50% okay with this concept now, till now, all what we have learned, then also it's fine, as we are going to practice it. See, don't expect you to be a superman or something, or Einstein or something. You are a normal person, and it is okay to not understand the concept in the very first time. And that's absolutely okay. If you are like 50% or 30%, if you have understood the concept, then it's also okay, because rest of the 70 or 50% will be covered by practicing the concept and the formula again and again. So if you will solve 10 questions, just imagine that after writing 10 times this concept in a different question, your confidence level or your understanding level of the concept will obviously increase from that point onwards now. So don't expect yours like too much from yourself and get demotivated. Have patience. The last concept is the perpetuity, and this is being used in security valuation chapter, portfolio management chapter, and corporate valuation chapter, derivatives chapter, no, not derivatives, mergers and acquisition chapter mostly. So again, this is going to be an important part. What do you mean by the perpetuity? Let's understand the concept first. The perpetuity means something which has no ending. Means if you are investing some amount today and you are investing it for n number of years, for your lifetime, so there is no terminal value, no end of the period, no t in the formula. See, t is perpetual, there is no limit to it of investment. Now my question to you, very simple question. Let's say, for example, you invest 1000 rupees today at 10% rate of interest with the bank. If you keep FD, you keep anything. So if you keep 1000 rupees in FD at 10% rate of interest, you will get 100 rupees every year. For how much period? For the period as long as you keep that 1000 rupees with them. So there is no ending to that. Okay. If you keep it for perpetually, they will have to pay interest perpetually. Rate of interest is 10%. Now please understand, this 100 is being called as annual cash flows, or we can say periodical cash flows, because it can be paid half yearly also. In other word, we can call it as perpetual cash flows. It's better to call it as perpetual cash flow. So perpetual word itself means this cash flow is going to continue for years to come. Okay, this 1000 rupees invested today is called as value of perpetuity. Now I'm going to come up with the formula of how to calculate the value of perpetuity, how to calculate 1000 rupees, because this is what will be used in the coming concepts. We will start from the same concept of simple interest is equal to principal into rate into time. We will derive the formula from here only. First of all, we will remove time, because in perpetuity there is no time limit. Now the formula is left with P into R only. P, simple interest, means the annual interest that you will be receiving. We call it as perpetual cash flow, or we can call it as periodical cash flows. And P is nothing but the value of perpetuity and rate of interest. So value of perpetuity, P is nothing but periodical cash flows. R will go on that side, it will come into the denominator, and this is your formula. That's it, simple, very simple. But most of the students will make mistake in understanding the timing of two cash flows. See, 1000 rupees invested today will give you 100 rupees at 10% rate of interest. Am I right? If you do the calculation on the right hand side, you will get the figure of the left hand side, and that's why LHS is equal to RHS, hence proved. But now 100 rupees is received at the end of first year if you invest 1000 rupees at time 0. So please understand that if you invest at time 0, then only you will start receiving cash flows at time 1. Have you ever experienced a situation where you have invested 1000 rupees today and today itself you are asking them for a return of 100 rupees? It is not possible. Bank will ask you to stay invested for 1 year at least to receive that 100 rupees. So what I want to say is, if you want to calculate P0, the numerator should be cash flow for end of year 1. It cannot be CF0. It has to be CF1. There should be a gap of 1 period in between the P and CF. Then rate of interest. Now, if I say that if we want to calculate the perpetuity value at the end of year 1, we will have to use the cash flows from second year onwards, because any amount invested at the end of year 1 will give you cash flows, will start giving cash flows from year 2. Rate of interest. Now let me give you some more example. Let's say if we use CF5 and we divide it by the rate of interest, what will be the perpetuity for which year the value of perpetuity will be arrived? It will be for P4. Understand this concept. This is very important. Lots of students are making mistake yet. What they do is they are like, CF5 will be used for P5. That's not logical, right? No, this is how the formula is. P0 is being calculated by using cash flow for year 1. P1 cash flow for year 2. If you want to calculate P3, you will have to use the cash flow for year 4. So at any point of time, if you calculate any cash flow, it will give you the perpetuity value of 1 year backwards, or we can say that before, previous year. Okay. And also understand that if we, let's say for example, I want to calculate P4, it will be CF5 means this amount divided by rate. So 100 divided by 10% will give me 1000 rupees. Now what does that mean? It means that this 1000 rupees includes all interest earned from year 5 onwards. So from year 5 onwards, all the amount has been included in this 1000. Now if I want to calculate the present value at time 0, what I should do? Present value at time 0 is nothing but the present value of future value. That's what we have learned, right? If you remember the formula, present value is nothing but present value today is nothing but multiplying the present value factor with the future values. And what are the future values? In this case, the future value for this time is this one, this one, this one, this one, and this one. That's it. The 400 rupees, the 100, 4 times, and that 1000 rupees includes the entire future of this scenario. You cannot say that this is also the future now. If you are considering, see, if you are already taking 1000 rupees and this 1000 rupees includes 100 rupees, you cannot take that 100 rupees separately. Getting it? So taking this 100 rupees will be wrong. So there are only 5 cash flows which includes entire future of this present value, 0 time. So in order to arrive at this present value, you will have to calculate the the present value of all those 100 for 4 years and that 1000. And if you'll understand, this 1000 is at P4, this 100 is at CF4. So you can multiply with the same present value factor to both the cash flows. Now how you will arrive at this, I will just show you here. See, first 100 into first year factor, second 100 into second year factor, third 100 into third year factor, fourth 100 and 1000 P4, CF4 plus P4 into fourth year factor. The total of all these will give you the present value at time 0. This 1000 rupees includes the entire future, first year, second year, third year, fourth year, and this includes fifth year onwards. That is how we should calculate. It's okay not to understand this entirely. We are going to use it in many questions, and at that time we will brush up our concept. So for now it's enough. I think we have done very well by being with me till now. So what we have covered till now is all this: compound amount, annual compounding, semi-annual compounding, quarterly compounding, monthly compounding, daily compounding, effective rate of interest, then present value, future value, present value of annuity, perpetuity, and that's it. Okay, let's reach out to this and finally write down all the formulas. What was the formula for effective rate of interest? It is nothing but 1 plus r divided by n to the power nt minus 1. If you remember, future value is equal to, no, we will say present value is equal to future value into present value factor. Present value of annuity, how to calculate that? Annuity multiplied by present value annuity factor. And how to calculate the value of perpetuity? Means present value of cash flows. It is nothing but the cash flow at 1 divided by rate of interest. That's it. These are the 5 formulas. Now from now onwards, what you have to do is you have to revise these formulas again and again from the formula book. Okay, so if you go through the formula book, you will see that in under the time value of money, here we have given all the formulas: simple interest, compound amount, effective rate of interest. Okay, can you see it? All the 6 formulas are there, and if we turn the page, we will find that here. Just let me start the AC. Yeah, so simple interest, SI into P into R into T. Then comes the compound amount formula, effective rate of interest, 1 plus R divided by N to the power T minus 1. Present value, future value formula. Then present value of annuity formula here. Present value of annuity is equal to annuity into present value annuity factor. Then perpetuity, periodic cash flows divided by the rate of interest. Okay, the variables may vary, like the names may vary in different reference books, but the concept is same. So you should understand that. After that, what starts is the basics in ratios. Now, ratio analysis was the chapter that was covered in CA Inter Financial Management, and these formulas are not the part of the our syllabus at SFM, but all these formulas are being used in different questions in SFM. So that's why these formulas has to be learned. But I'm not taking it right now. What I'm going to do is I'm going to take these formulas in the respective question itself. So what you can do is you can just go through it once. Then comes the formulas of our syllabus, which starts from chapter 2 risk management, and we are going to continue learning what is standard deviation, this standard deviation, and some concepts which are also used in the portfolio management chapter. And then we'll start with the chapter 2 risk management from the next lecture. Till that time, bye bye from my side.